Hey everyone, welcome back. And if you are new here, welcome. Before we start, thank you. This channel is growing because of you. Every view, every comment, every subscribe, I do not take that for granted. Now, what I am about to show you is something almost nobody is talking about. Let's get into it. In 1999, the US dollar made up 71% of every central bank reserve on Earth. Every country held dollars. Every country needed dollars. Today, that number is 56.9%, the lowest since 1994. And the speed of the decline is what should worry you. It took 20 years to lose the first 7 points. It took 5 years to lose the next 7. The dollar is not collapsing. But something is changing underneath it, and almost nobody is paying attention to how fast it is moving. Let me show you what is actually happening. In January of this year, 9 countries in Southeast Asia, Brunei, Cambodia, Laos, Malaysia, Myanmar, the Philippines, Singapore, Thailand, and Vietnam reached a joint agreement to accept a future currency created by a group of countries you have probably heard of. BRICS. That is Brazil, Russia, India, China, South Africa, Egypt, Ethiopia, Indonesia, Iran, and the United Arab Emirates. 10 countries, 45% of the world's population, over a third of global GDP. And now, 9 more in Southeast Asia are preparing to join the system. That means nearly 19 countries could be trading with each other without touching a single US dollar. But it does not stop there. The Commonwealth of Independent States, 12 countries that used to be part of the Soviet Union, now conduct 85% of their trade in local currencies, not dollars. Rubles, tenge, some, manat. In 2024, only 15% of transactions between those countries used dollars. 5 years ago, it was over 60%. Russia and China have gone further. 99.1% of trade between those two countries now settles in rubles and yuan. The Russian finance minister confirmed this number just weeks ago. Iran and Russia have completely removed the dollar. Their words, not mine. The Iranian trade representative said, "We have entered into a currency agreement and fully removed the US dollar." China has signed currency swap agreements with over 40 countries. That means 40 governments can now buy and sell goods with China using yuan instead of dollars. Brazil and China agreed in 2023 to settle all bilateral trade in yuan and reais. China is Brazil's largest trading partner. Over $100 billion a year. That entire flow now bypasses the dollar. Egypt confirmed in 2025 that it is using local currency settlements for transactions with other countries in the group. Saudi Arabia, the country that created the petrodollar, is now considering adding yuan-denominated futures contracts to the pricing model of its oil. And India, which hosts the next summit later this year, has asked the Reserve Bank of India to push a proposal for linking central bank digital currencies across all member countries. So, let me count. Russia, China, Iran, Brazil, India, South Africa, Egypt, Ethiopia, Indonesia, UAE, Saudi Arabia, 9 Southeast Asian nations, 12 former Soviet states. That is not a fringe movement. That is a parallel financial system being built in real time. And it is happening faster than anyone predicted even 2 years ago. In 2023, BRICS had 5 members. Today it has 10 full members and 13 partner countries. Indonesia joined, the UAE joined, Saudi Arabia joined, Egypt joined. These are not small countries on the margins. These are energy producers, manufacturing hubs, and some of the fastest growing economies on the planet. Together, BRICS countries now produce over 40% of the world's oil. They manufacture over 50% of the world's goods, and they are home to nearly half the global population. When a group that large decides it wants to trade without you, that is not a protest. That is a restructuring. Now, I need to be honest with you about something. Headlines like "the dollar is finished" are exaggerated. The dollar is not finished. It is still by far the most used currency on Earth. 50% of all global payments go through dollars according to SWIFT data. The dollar is on one side of 89% of all foreign exchange transactions. No other currency comes close. The euro is second at 21%. The Chinese yuan, despite everything I just told you, makes up only 2.7% of global payments. So why should you care? Because this is not about the dollar disappearing tomorrow. This is about the dollar losing its pricing power slowly, year after year, until one day you look up and everything costs more. Here is how it works. And I want you to understand this because it affects your wallet directly. When the dollar is the world's reserve currency, every country needs to hold dollars. They buy US government bonds to hold those dollars. That creates massive demand for American debt. That demand is what keeps US interest rates lower than they would otherwise be. Economists call this the exorbitant privilege. The US can borrow more, spend more, and pay less interest than any other country on Earth, because everyone else needs its currency. One estimate puts the savings at about 60 basis points, 0.6%, on the entire national debt. That does not sound like much, but on $36 trillion of debt, That is $216 billion a year in lower interest costs. If countries stop buying dollars, they stop buying U.S. bonds. If they stop buying bonds, the U.S. government has to pay higher interest rates to attract buyers. Higher rates mean higher costs for mortgages, car loans, credit cards, student loans, everything. And it does not stop at interest rates. When the dollar weakens, imports get more expensive. Oil, electronics, food, clothing, anything that comes from overseas costs more in dollar terms. The dollar index fell 10.7% in the first half of 2025. That was the worst first half performance in over 50 years. In January 2026, it fell another 1.2%. Now, some of that is a correction after years of dollar strength. The dollar rose about 40% between 2010 and 2024. A pullback is normal. But the question is whether this is a pullback or a trend. And the data is starting to look like a trend. Foreign ownership of US Treasury bonds has fallen from over 50% during the financial crisis to about 30% today. China alone has cut its Treasury holdings from $1.3 trillion in 2013 to $682 billion in late 2025. That is nearly half. Gone. And where's the money going? Gold. Central banks bought more gold in the last 3 years than at any point since 1967. China, Russia, Turkey, India, and Poland have been the biggest buyers. Gold's share of global central bank reserves has doubled in the last decade, from about 4% to 9% in emerging markets. In developed countries, gold already makes up 20% of reserves. Gold just passed $5,600 an ounce. JP Morgan forecasts it could reach $4,000. Wait, it already blew past that. The trend is clear. Countries are trading paper dollars for physical gold. And it is not just the usual suspects. Poland, a NATO member, a US ally, has been one of the most aggressive gold buyers in the world. Turkey, also a NATO member, same thing. Even Singapore and the Czech Republic are increasing their gold reserves. When your own allies are quietly converting dollars to gold, that tells you something the headlines are not saying. And Africa is moving too. Ghana has started paying for oil imports using gold instead of dollars. Tanzania has banned the use of foreign currencies for domestic transactions. Nigeria has joined BRICS as a partner country and expressed interest in local currency trade agreements. These are countries that used to have no choice but to use dollars. Now they are building exits. And this is where BRICS comes back in, because the new settlement tool they're building, called the unit, is designed to be 40% backed by gold and 60% by a basket of member currencies. A pilot of 100 units launched on October 31st, 2025. It uses blockchain technology. It is designed to allow cross-border trade without dollars and without SWIFT. Is it ready to replace the dollar? No, not even close. The infrastructure is in early stages. The currencies involved are volatile. Capital controls differ enormously between countries. India's own trade minister said a shared currency with China is impossible. But that is not the point. The point is that for the first time in 80 years, a group of countries representing nearly half the world's population is actively building an alternative. They are not asking permission. They are not waiting. They are doing it. And the irony is that US policy is accelerating it. When the United States froze Russian central bank reserves in 2022, $300 billion frozen overnight, every central bank on earth took notice. The message was, if you hold dollars and you do something Washington does not like, your money can disappear. That was the moment the movement went from theoretical to urgent. Think about it from the perspective of a central banker in Brazil, or India, or Saudi Arabia. You have spent decades accumulating dollar reserves. You trusted the system. And then you watched 300 billion disappear with the stroke of a pen. It does not matter whether you agree with the reasons. What matters is that every central banker on earth now knows it can happen to them. That single event did more to accelerate de-dollarization than 50 years of academic debate. Jane Foley, the head of currency strategy at Rabobank, said it clearly. US trade and foreign policies have forced other countries on a path toward reduced reliance on the dollar. And then came the tariffs. The new 10 to 15% global tariffs under Section 122 are pushing even more countries to find alternatives. Because when you punish countries for trading, they find ways to trade without you. The president himself has acknowledged the trend. He said, and I am paraphrasing, any country that leaves the dollar will face a 100% tariff. But think about what that means. If you have to threaten countries with a 100% tariff to keep them using your currency, that tells you the currency is no longer holding on by its own strength. It is holding on by force, and force works until it does not. Now, let me tell you what this means for your money. If de-dollarization continues at this pace, 3 things happen. First, inflation stays sticky. A weaker dollar makes imports more expensive. The US imports about $3.8 trillion worth of goods every year. Even a 5% weakening of the dollar adds roughly $190 billion in higher costs. Those costs get passed to you at the grocery store, at the gas pump, at the car dealership. Second, interest rates stay higher for longer. If foreign demand for U.S. bonds keeps falling, the government needs to offer higher yields to attract domestic buyers. That means the Fed cannot cut rates as aggressively as markets want. Mortgages stay expensive. Car loans stay expensive. Credit card rates stay near record highs. Third, gold and hard assets keep rising. When countries trade dollars for gold, the price of gold goes up. When currencies become less stable, people move to things that cannot be printed. Gold, silver, commodities, real estate, and stable markets, all of these benefit when confidence in paper money erodes. And here's the thing most people miss. This does not require the dollar to lose its reserve status. It just requires the dollar to lose share. Going from 71% to 57 already changed the math. Going from 57 to 45 would change it dramatically. The Brookings Institution published an analysis just this week. Their conclusion? While there is a longer-term decline in allocations to the dollar, it does not look like a sudden break. It looks like a slow erosion. Slow erosion. That is the key phrase. Because slow erosion is how every reserve currency in history has ended. The Spanish real, the Dutch guilder, the British pound. None of them collapsed overnight. They all lost share gradually, over decades, until one day the world woke up and realized it had already moved on. The British pound was the world's reserve currency for over 100 years. It did not lose that status because of one event. It lost it because Britain's share of global trade kept shrinking, its debts kept growing, and other countries found alternatives. The transition from the pound to the dollar took about 30 years, from the 1920s to the 1950s. It was not dramatic, it was gradual, and most people did not notice it was happening until it was already done. The US today has some uncomfortable similarities. Its share of global GDP has fallen from over 30% to about 25%. Its share of global exports is declining. Its national debt is $36 trillion and growing, and its currency is being used as a tool of foreign policy in ways that make other countries want to find exits. The dollar still has enormous advantages. The deepest capital markets, the most liquid bond market, the strongest institutions. And no single rival, not the euro, not the yuan, can replace it today. But the world is not looking for one replacement. It is building many. A yuan corridor here, a rupee settlement there, a gold-backed unit for trade between countries that used to need dollars. Each one small, each one manageable. But together, they form a pattern. And patterns, once they start, are very hard to reverse. And here's something that should really make you think. It is not just BRICS. It is not just the developing world. Even Europe is questioning its reliance on the dollar. European central bankers have started asking whether they can continue to depend on the US Federal Reserve for dollar funding during times of stress. European investors are pulling money out of US equities and putting it back into local assets. In the first half of 2025, European-focused funds received record inflows. The euro's share of global reserves rose from 19% to over 20% last year. That is the highest in years. And European bond issuance, particularly in Germany, which just unlocked massive new spending, is giving global investors an alternative to US Treasuries for the first time in decades. When Europe starts hedging against the dollar, you know the shift is real. JP Morgan put it this way: de-dollarization is most visible in commodity markets, where a large and growing proportion of energy is being priced in non-dollar contracts. Energy, the thing that created the petrodollar in the first place. If oil stops being priced exclusively in dollars, and it is already starting, the foundation of dollar demand weakens, not collapses, weakens. But in an economy running $36 trillion in debt, even a small weakening has enormous consequences. So what should you watch? 3 things. First, the dollar index. If DXY breaks below 95 and stays there, that signals a structural shift, not just a correction. It is currently around 98. The 52-week low is 96. Second, foreign holdings of US Treasuries. If the decline from 50% to 30% continues toward 25, that is a clear sign that demand for dollars as a reserve asset is fading. Total foreign holdings are still at a record $9.35 trillion. But the share is what matters. The pie is growing, but America's slice is shrinking. Third, gold. If central banks keep buying at this pace, and they show no signs of stopping, gold is not just a hedge anymore. It is a vote of no confidence in the current system. Watch the BRICS summit in India later this year. If they announce an expansion of the unit pilot or new currency swap agreements, the next wave of de-dollarization will be underway. The dollar is not dying, but it is being replaced, quietly, slowly, deal by deal, country by country. And the question is not whether it will happen. The question is whether you are prepared for what comes next. If you found this useful, subscribe. Every video on this channel is about what the numbers actually show, not what the headlines say. See you in the next one.